Hey everyone, me Kevin here. So this morning we had some data that came out from the jobs market, and that's really important because even though usually jobs are a lagging indicator, that is, companies see, consumer spending is going down, oh no, we better cut jobs or stop hiring so that way we can protect our bottom line, and that is usually a lagging indicator of a recession. Generally, that's what we see. One of the tools that we can look at to try to understand, hey, is what the Federal Reserve is doing working? It's called the JOLTS. It's a measure of job openings. And even though that too is a lagging indicator, it is one that's really, really closely watched because people want to know, hey, is the Federal Reserve hiking rates working? Because guess what, folks? If it ain't working, well, crap, that means we got more pain ahead because then the Fed has to come out and be like Marie Daly this morning going, we're a long way away from getting inflation down. Don't get too complacent. Our job is not done here. Our work is important. Please pay attention to us more. That's kind of what the Fed wants. They got the limelight, and they're like, don't stop paying attention to us just because we rallied a little bit off July. Don't get excited. The work's not over yet. All right, fine. So what's really important here is that if we get a JOLTS reading that shows there are more job openings rather than less, then it shows that businesses don't really care about higher rates and that the impact of higher interest rates haven't really hit the broader labor market yet, or companies yet. That would actually be bad because that would be a sign that the Fed is trying to move markets in one direction, depress demand, and by depressing demand, depress business activity, overall depress spending to bring inflation down. That's what the Fed's trying to do, right? And the Federal Reserve in the last FOMC meeting came across as actually somewhat dovish, which is a way of saying that like the Fed's kind of like, yeah, looks like our work here is starting to have an effect, especially with the first line of their statement. The first line of their statement for the first time this year was changed to, it seems like the economy is actually starting to slow down a little bit. I'm paraphrasing, but that is true. They've changed it from the economy's growing and expanding to, oh, things are slowing down a little bit. And along with that, the Fed's like, hey, so we've gotten to neutral rate, the stuff that we do has a little bit of a lag time. We think it might be appropriate to slow down a little bit here in the future. Those comments came across as actually very, very bullish to markets. Markets are like, oh my gosh, this is it. The Fed is U-turning. So obviously, if we get a JOLTS number that is way above the economist estimates, then we're screwed. Because it means that the Fed is actually wrong to be suggesting, oh yeah, things are softening, right? Well, the good news is the JOLTS number came in our favor today. Now, we're going to touch on that and kind of what it means for the broader market, and is there the potential for more of a decline here? Well, let's hit this. So the first thing that you have to know is that the expectation was that we were going to have 11 million job openings. That would be down from the last job openings report we had at about 2.54 million. Now keep in mind, last month we were expecting 11 million openings as well, and we got 2.54. So this report came out and they actually revised up this we're reading here by about 49,000. So this came in at 250. This was revised up to 11,303,000 job openings. This should be a K right here. But anyway, that was revised up to 11,303,000 job openings. So that's a plus 49K. But the estimate of 11 million was missed by 302,000 jobs. The number came in at 10,698,000, which is good. You can't write properly here. There we go. Which is good because it means that the Federal Reserve is actually starting to see what they want to see. Remember what Jerome Powell told us. Jerome Powell told us that right now we have 1.9 openings for every single one job that there is. One unemployed person that there is. So this right here is your unemployed person, and this is your opening right here. And Jerome Powell wants to see this in balance. And you bring this in balance by crimping down on companies and reducing people's spending, which then leads companies to say, well, then we don't need to hire as much. And Jerome Powell wants to see this be in line at about 1 job opening per 1 unemployed person. So if you have 6 million unemployed people, you want to see this being at about 6 million for the JOLTS reading. So we're finally slowly starting to go in that direction. This is called a cooling. It's not like a big shock. You know, if this number came in at 8 mil, it's like, oh my gosh, yeah, like this is it. This is going to be a bad recession. That's not what we got. So we didn't get like really ugly news that says, oh, we should be really concerned. If anything, we actually got data here, which we don't get a Fed meeting until September 21st. We just got Fed data that gives us the thumbs up and says, hey, what the Fed said in the last meeting is working, and the data is reiterating it. Now we have jobs data coming out at the end of this week. We've got inflation data coming out on the 10th. That's next week. That's going to be critical. Right now, the expectations, and you might think this is crazy, okay? But the expectations for inflation next week, folks, holy crap. It's only a 0.2%. Let me write that a little bit better. It's only a 2% month-over-month expectation, or 0.2%. That corresponds to 2.4% annualized inflation. That'll be like the lowest read that we've had in a very, very, very long time. So that would be very, very good. And that also would go with reiterating this JOLTS report that we just got, that the Fed is actually on the right course. So what does that mean? Well, this means a lot of folks are really looking at this market as, you know what, this is the time to buy. This is the time to move from cash and move over into quality stocks. Speculative assets are still having a rough time. We saw what happened to Roku. We saw what's happening to lower income related stocks. Those are going to be kind of your Walmarts and your Targets and your Best Buys versus like the Amazon, the American Express, the Visa, where we're still, Louis Vuitton, where we're still seeing a boom. And so you are seeing a favor towards quality, Apple, Google, Amazon, and still a risk-off approach to some of the more speculative names. But, folks, we've got 7 weeks to go before the next Fed meeting, and as long as the data keeps coming in like this, it reiterates that, wow, we might, yes, actually be at or beyond now a bottom. Now, one thing that's wonderful to keep an eye on, and we talked about this in the morning opening live stream that we've brought back, is take a look at this. When we redraw the Fibonacci's from the top of the year to the bottom of the year, we can actually see that right now we're sitting at a 38.2% retracement from bottom to where we sit roughly now. And even though the NASDAQ is down 0.5% today, what's really incredible is that where the NASDAQ sits right now is where it's getting rejected is actually at the same level that marked the bottom in February, March, and briefly in April before we broke that. And then we ended up bottoming out in June. And so it's really interesting. This level at about 318 NASDAQ, really, really critical. If the data keeps coming in to support that the Fed is on the right track, that inflation break-evens are right and inflation's going to trend down, then we could see a real rally. Potentially, I would say, up from 38.2 all the way to about 78.6. I don't actually think we should be past 100 probably until like the end of the year, maybe even next year, like a Christmas rally or beginning of next year rally. I do think there's a nice room for continued rallying here, especially if we get good CPI numbers. So personally, I'm looking at this market saying, hey, I'm 99% long. I've got a 1% short position. I'm also shorting the dollar, so that's somewhere around 1-2%. These are nominal positions, but those are trades that I think are great, and one of them's a hedge, one of them's a trade. I'll talk more about those at a different time. But I do think right now where we sit in the market is a testing point right here. And I think that after this JOLTS data, the only reason we're red right now is because Nancy Pelosi is going to Taiwan. And therefore, you could take short-term uncertainty, potentially move in, but do keep an eye. If we get a bad CPI read, we could easily retrace back to QQQ 300 or all the way back down to where we were previously, that 268 level. We'll see. Thanks so much for watching, folks. We'll see you in the next one. And make sure to get up to 12 free stocks with Webull by going to metkevin.com/Webull.